Welcome to Cambridge House Live. I'm Bridget Anderson. I'm joined by Keith Schaefer, the editor and publisher of the Oil and Gas Investments Bulletin. Nice to see you again, Keith.
Thanks for having me, Bridget.
Let's start off talking about LNG. 2013, not the year that many had hoped for. What are you thinking will be a catalyst for 2014?
Well, I think the big reason 2013 didn't turn out the way we wanted was because the BC government did not say what its tax regime was going to be for LNG.
Big question still.
And that was going to happen in October, and they put that off now till February, which tells me that the dance they're doing with the industry is still happening. But what I'm hearing lately is that we are going to see some very definitive numbers come down in February, and that should be the first big catalyst. And I think obviously if you're going to spend $20 or $30 billion in infrastructure in this province, you want to know what your tax regime is going to be. So for Petronas, Shell, all these companies, Exxon, Apache, they're going to want to see that. And everything I'm hearing says we're going to be happy with what we hear. And that should be a pretty big catalyst for these companies to then say, yes, we're going to give it a go. And I would expect two, what we call an FID, financial investment decision this year. One will be from the really small company called Golar. That's going to be a very small offshore barge that ships LNG. And the other one should be Petronas, which is much larger. And I think we'll see both those FIDs this year.
Well, there are about 14 proposals for these projects, right? So that's a lot of players in there. How do you think that is going to shake out? And when investors are looking at opportunities, you know, they can't think that all 14 are going to make it to the end.
Right, and there's no way we can fit a pig in that python anyway, right? Like Terrace, Kitimat, and Prince Rupert are very small towns. So what I expect to see happen is that the industry is going to watch these first two for a couple of years and see how they're doing. And so they'll be able to see how they're moving ahead, the leaders are, and how the market for LNG, because right now it's very, very positive. You know, LNG is trading for $18 on the spot market in Japan these days. So it's winter, that's expected, but great profit margins right now, but will that continue? So I would expect those to be the only two projects for the first couple of years, and then the rest of the industry will be a full 2 years behind before deciding to jump in or not.
But even still, probably not going to see all 14 get to the end.
No. You're only, we'll separate the wheat from the chaff slowly over those 2 years, where a couple groups will just say, no, either the economics don't work, or you know what, we weren't first, so we're going to be late, we'll just forget it. So.
We talk about being late. Is BC, Canada, late to the game compared to Australia, or is there enough room for both players?
Well, you know, we're talking about some very long timelines here, so the short answer is nobody knows. But right now, Australia should be coming online next year. So that's a nice big jump. The US is going to be next, though I think most of their exports are going to end up going more to Europe, just because between the Panama Canal and economics of getting to Asia, I'm not convinced you're going to see near as much exports from the US to Asia as everyone thinks right now. That still leaves a pretty big gap for Canada. And as long as our gas is under $8 and their gas is still $15, $16, and it's quite a bit higher than that right now, I still see an industry. Plus, I think the big trend over the next 20 years is going to be away from oil to natural gas.
Well, and part of the conversation when it comes to natural gas is fracking, and a lot of concerns about that. But you have come across EOG Resources, and recently they've unveiled a new fracking technology. So tell me a little bit about this, and what does that mean for investors?
Well, this new technique is actually very simple, and it's not going to be anything that really contributes much to the discussion around fracking, but it will contribute discussion to is production, because what EOG has done is they've gone, for the last 5 years, as fracking has just taken off around North America, all the companies have been doing long, skinny fracks into these oil and gas formations, thinking that's the best way to get most of the oil and gas out as they can. But what EOG has shown in the last 6 to 9 months, so it's still early days, but they have dramatically increased the amount of oil coming out of these wells with short, wide fracks close to the wellbore, as opposed to long, skinny fracks out into the formation. So it's a very simple technical change, but it has meant a step change in production for these companies. So the amount of oil and gas that they're able to get out is increasing, and of course the cost base of that gas is lowering. So now you're going to be able to get a lot more gas and oil out a lot cheaper. So we talk about the shale revolution creating a whole new renaissance in North American energy. Well, if this pans out, we ain't seen nothing yet.
But what about the transportation? I'm thinking mostly the transportation of oil, and particularly by rail. I mean, I think the last 6 or 12 months we've seen a few incidents, and there's some concerns about this. So is that going to be a hurdle?
Oh yeah, the regulators in the industry have been way behind the curve on this, sadly, as they have been for most of the shale revolution when it comes to getting the general public on board. But it's pretty obvious now that the rules that are in place by the states, the governments, and by the industry itself, including the railway industry, just weren't ready for what was hitting them. And so, you've basically gone from 2 years ago, hardly any oil by rail, now to seeing 400,000 barrels a day shipped all over the continent. There's new safety regulations that need to be developed. There needs to be an understanding of all what happens here, as we saw in Lac Mégantic, and the whole idea. So
how much of a constraint is that going to be?
I'm really surprised it hasn't been more of a constraint. I think the public has been very forgiving for the industry for what's happened so far, and I'm really kind of surprised it hasn't been as big a deal. Like it's big in the press, but there's been really no movement forward by either the regulators or the industry to make the public, give them some real facts and figures to say, yes, there's new regulations, there's new rules. None of that's happened, which I would have thought would have happened really quickly, considering the deaths that we've seen.
So something to keep an eye on for sure.
I think so. I think that's still a story that has yet to fully play out for the industry.
Okay, another story that's playing out, you were keeping an eye on refineries last year. And this has been a part of the conversations that if we're going to produce this, then you're going to need a refinery to do something with it. And some big news coming out last year regarding refineries and some investment. So what do you see happening on that front?
Well, certainly in 2012 and 2013, the refinery stocks had a fantastic years because the shale revolution produced so much oil here in North America that our oil price became a big discount to the world prices. So oil prices were at a discount, but all the gasoline and refined products were still being sold at world prices because you're not allowed to export oil, but you can refine products. So what's happening right now is that there's a big discussion starting in Congress, should we allow oil exports because we have enough oil? Now, the reality is they don't. They're still importing over 7 million barrels a day. And despite the best, most optimistic projections of the shale revolution, the U.S. is never going to supply 100% of their own needs. They won't.
Could be good news for Canada.
Yeah, it should be good news for Canada, but part of energy independence is having the refining capacity to do it. And right now, certainly on the light oil side, they don't have it.
Well, and you're bringing up light oil, so what should investors be looking for on that front? Because we were talking before we started the interview just about seasonality as well.
Right, so I think the oil price, particularly the light oil price in North America, is really getting set up for a big drop. So what I think is going to cause that here is right now the polar vortex that we talk about, how it's so cold right now.
Yeah.
Of course, this is how cold it was every year when I was growing up, but for the last 30 years, this is an abnormally cold winter. And so it's creating a lot of temporary excess demand that's matching the permanent excess supply that we're seeing continually coming out of both oil and gas in North America. So as soon as this cold weather stops, Bridget, I just don't see how commodity prices, particularly light oil and natural gas, are going to have a pretty big drop because there has been a sustained increase in production that's just being masked by this cold weather.
And that will come to an end pretty soon, you'd think.
You never know with the weatherman, but certainly by March, when spring shoulder season starts, I would think you're going to see a pretty big drop.
Okay, now I wanted to talk to you about ethanol as well. You did quite well with it last year, but there are some challenges there for investors, so walk us through that.
Sure, so ethanol is just gasoline made from corn. And it's very simple economics. When you have a big corn crop like you had in the US last year, excess supply means lower prices. And lower corn prices means higher ethanol profits.
Right.
So right now we're in a situation where the margins for ethanol are very, very strong because of this bumper corn crop. But the thing to watch out for this year would be a lowering of the gasoline price. Americans are driving less and less every year, so it's possible that gasoline prices could come down. And then I guess the other thing is that we're now producing more ethanol than we use in North America. So we're reliant on exports. And exports are soaring because our ethanol is so cheap. But if other countries like Argentina and Brazil in particular are able to have also bumper crops and their ethanol becomes very low cost, they could supplant us, and it wouldn't take much. Ethanol is very volatile. It wouldn't take much to reverse that. But right now, I would suggest 2014 should be the best year in history for ethanol.
Okay, we'll be keeping an eye on that. Thanks very much, Keith.
God bless you.